Savings and loans were originally designed as community thrift institutions geared towards helping working-class American families save for owning a home. As interest rate volatility in the 1970s, brought on by rampant inflation, caused S&Ls to lose money, pressure mounted to relax regulatory standards and allow riskier, higher-yield investment speculation involving high-profile commercial real estate backed by junk bonds. Losses continued to mount, however, and by the 1990s, over 1,000 S&Ls had failed out of a total of about 3,000, costing taxpayers approximately $160 billion through the Resolution Trust Corporation. Until the financial crisis of 2008, it was the most expensive banking bailout in U.S. history.
Well, I'm not a crook. I've earned everything I've got.
Military-industrial complex.
A new world order.
But we are here to destroy the control over the industry of other people.
I did not trade arms for hostages.
It's been time dealing.
На полный разгром гнусных захватчиков.
Myth20c podcast.
Hello, everyone, and welcome back to the Myth of the 20th Century podcast. I'm Hans Launder, and today I'm joined by two of my great co-hosts, Mr. Adam Smith.
Hey.
And Mr. Hank Oslo.
Hey, everyone.
So this has been kind of a long time in the making, something I've wanted to do for a while, mostly because I'd always heard rumblings about it, and it seemed like the financial crisis that was sort of memory hold, especially after '08. It almost feels like people forgot that the savings and loan crisis existed, and it became sort of a footnote in a lot of documentaries dealing with actually the '08 crisis, and they would chart the history of financial crises and banking problems in the United States. And you'd get maybe 2 minutes of a documentary or a quick interview with someone like Bill Black, about Charles Keating. But you never really got the full story. You would hear rumblings here and there about Silverado with Neil Bush. You'd hear rumblings about the CIA. You'd hear about Keating. Yeah, you'd hear about various problems, but you never really get the full story, and you'd never really understand what happened. I don't know what you guys really know or knew about the S&L crisis before we started looking into it. But I mean, to my knowledge, it feels like a crisis that's been forgotten.
I would agree. And just while we're talking about banks and money, I had a very small donation that came in, which is still very much appreciated, from the Bitcoin wallet, starting with the characters 3KUO. Thank you. But regarding the S&Ls, I just vaguely remember it kind of being discussed as something that was sort of being blamed on like the Republicans and Reagan and people like that. In terms of the actual mechanics of it, it was sort of a very complicated process, and it was obviously not directed by the White House, but there were a series of regulatory changes that enabled a lot of the leveraging that happened at the savings and loans. And that requires, I think, going into some of the history and how those organizations were founded. But in terms of the money, at the time, I think it was certainly the largest public bailout of the financial sector up until the 2008 financial crisis. I think the total amount set aside for bailing out the banks was on the order of $450 billion. And then the actual money that was basically just lost in order to, prop up those banks or make the savers whole, I think was $150 billion, as compared to about $750 billion plus various other quantitative easing measures by the Federal Reserve during the 2008 crisis. So it was a fairly large amount of money. Not as large as 2008, but I think at the time it was the largest in history in the United States.
Hank, any thoughts?
Yeah, I mean, it was always kind of
The technical aspects of it, I think, were kind of overplayed. Like you can always kind of ascribe when you have a failure, you can ascribe that to anything that kind of made the institution weak to begin with. So it's not usually kind of put forward as a very simple narrative. It's usually put forward as like, oh, well, there's this deregulation and like things got a little bit too crazy. And then, all these institutions failed and somehow a bunch of people went to jail. And the linkage between those is kind of under discussed, like, because you can have just, a financial crisis that's, kind of exogenously imposed because a bunch of people are betting that the wind is going to shift one direction and it goes the other. But the actual linkage to corruption and to the banking financial political nexus, I think, is something that is intentionally obscured in a lot of the narratives that I've seen.
Yeah, well, there's certainly a lot of very nefarious cases of a lot of these banks being used as money laundering outfits for various shadowy organizations, including the CIA. But maybe we want to get into that a little bit later. And Hans, of course, if you have an outline, please proceed. But my thinking was we'd sort of talk about how these sort of S&Ls came to be. What are they? I mean, we don't really have things that are called like savings and loan is what it stands for. We don't have these organizations with that emblazoned on their exteriors so much anymore, probably due to the fact that there was all these failures. But the type of organization or the institution is somewhat unique, I believe. So do you want to kind of start into how they came to be?
Sure. So I'm going to start with the U.S. has a really long history of bank failures. Is a member of, let's say, or call it Western industrialized nations. America really stands out as a place that's consistently had bank failures, but consistently managed to quickly overcome them and then have large periods of growth very rapidly thereafter. This has been attributed at the times these things were happening. They're often to lack of a central bank. As we saw, even after we put in a central bank, that didn't really change the nature of the fact that you have banking crises. It just changed the nature of the crises that you would have. Typically, they would be the result of larger and larger bubbles that were basically set off a couple decades apart, but very rarely. I think the first banking failure in the United States was in 1807 in Rhode Island. So not even a few decades after the end of the Revolution, there's a huge banking failure. Parts of the Northeast are left in kind of an economic depression. And then within a few years, rebound. And then you have, by the 1820s, you have mass industrialization. You have large scale growth in standard of living for most Americans. And you would have bank failures throughout the 1840s and the 50s and into the 1870s, and these problems would persist. And you have a couple in the 1890s and 1920s that have actually been sort of forgotten. A lot of the libertarian economists typically kind of cite these crises as evidence of you not really needing too much government interaction to resolve a crisis, and that they kind of take this Phoenix approach. Well, a crisis can be good. It burns down what they call malinvestment. The savings and loan crisis, there's an element of shadow work at play, but it was really started by real estate developers, mostly real estate developers, and very shoddy commercial loan interests that took advantage of a structure that was set up mostly in the Great Depression.
Right. The S&Ls were designed to give workers sort of a thrift account, a place to put their savings, and encourage a sort of positive social behavior in terms of investing in the future. And often that investment was directed towards housing. So I think that's how they were principally involved in real estate.
So at the beginning of, right around the beginning of the Great Depression, 1930, about 33% of Americans own their home, actually had real home ownership. A larger percent based off of that also either rented a home or had partial ownership or lived in nice tenements or nice apartments. A lot of the kind of how, this is before suburbs exist. You really don't have large scale suburbs. You have a very clear divide still between rural communities, small towns, and large cities, which is where homeownership is obviously lowest. The idea at the beginning of the Great Depression was essentially to grow and build our way out of the crisis. You see this again and again, and this is part of what creates the savings loan crisis and part of what creates 08 through the savings loan crisis. But it's this idea that if you manipulate the housing market, you manipulate the building markets, that you can grow your way out of a problem. So Delnor, or the FDR administration, basically took it upon themselves to say, well, we need to create a structure for Americans to get mortgages easier. We're looking at 30-year fixed rate mortgages. Small payments, even though at the time and historically Americans typically had 5-year mortgages, which had a very strong repay rate. They were repaid very often. Fraud was low. Bankruptcy was relatively low. You had a good mortgage structure because you limited who could feasibly buy a home. So by the sort of the end or the tail end of the savings and loan crisis, we had about 67% of Americans owning a home. So you double the number of people owning a home, outright owning a home. But obviously the crisis, and what we're going to get into, is the reason for that. You have suddenly it's very, very easy to get a house. So in 1921, there were a ton of banks, almost 30,000, let's call them small scale commercial banks. And a lot of them were state chartered, and a lot of them were single branch institutions. And they offered these sorts of services. They'd offer mortgages, they'd offer trust financing, they'd offer accounts, they'd offer all kinds of services. They offer all kinds of products very easily. When the Great Depression happened, a lot of those banks shuttered permanently, particularly just across the country, particularly in rural areas, but across the country, we had a widespread effect of bank failure. So again, FDR and his administration think what we need to do is create new institutions. So you have legislation passed in the early 30s, and the idea with a lot of these sort of home loan banks that are created, specifically through a body called the Federal Home Loan Bank Board. You have the creation of FSLIC, which is sort of the savings and loan version of FDIC. The reason you never hear about FSLIC anymore is that it went bankrupt in 1986, and it ceased to exist. That's something that I didn't know before really researching this, and it's kind of difficult to have to say this, but to put yourself in the shoes of someone living 32 years ago, when there's two branches. One is FSLIC, one is FDIC. You take both of these things for granted, and one of them ceases to exist overnight. Basically goes into complete failure mode because of accruing bad mortgages in Maryland and Ohio, showing you how widespread the problem was becoming. But FSLIC is created as federal deposit insurance for savings and loans, and specifically for these mortgages. So you could put money into a very, very low scale deposit account with a savings loan institution, and it was backed by a Fez up to about 40 grand at the time when this first. This was really unnatural to the sort of history of American banking culture. Again, American banking culture was one where you play fast and loose. You had banks offering all kinds of services, doing all kinds of different things. They were often very small scale. They often had nothing to do with one another, and they'd fail. Someone else in your community starts a new bank. Someone in the neighboring community starts a bank that services two communities until they split off. You had a variety of solutions. This is how you wound up with almost 30,000 banks without a lot of real strong regulation other than basic state chartering laws. But you have huge amounts of government bureaucracy being built up. And we've covered this in the progressive episode. This idea of centralization, this idea of large-scale organization coming into play in the 20s and then reaching its full fruition in the 30s. And this is sort of where it hits home ownership, and this is where it hits community banking. So FSLIC and the Federal Home Loan Bank Board start handing out federal charters. Again, something not really well known to Americans prior to this crisis. State charters are allowed as well. So you have institutions that are getting state chartered and federally chartered, and they're getting two different forms of insurance. They're having two sets of regulators. It becomes very cumbersome very quickly. A lot of these institutions can't really manage it on their own. They either require more staff, they go under, or they're effectively managed by the feds. By the late 30s, a lot of these small-scale banks and small towns are just being managed by federal agents in some ways. They're telling the bank owner what to do. They're giving what's called advice on interest rates to charge, and then there's federal caps on interest rates soon after that. And people get addicted to this idea that all you had to do was go to these new institutions, and it was federally backed. You could put whatever money you wanted into these accounts, and you could get a 30-year fixed rate mortgage, probably, from one of them. And it worked. It actually managed to work for a while. It worked for a couple reasons. A, because America was still a very small scale, high trust place. America was definitely a place that had a lot of rural wealth. You had a lot of it's called exurban and rural wealth, where people in the rural areas actually had a lot of savings and actually wanted a way to be able to build up their community. They wanted an easy way to give money to help their neighbor with his mortgage. And this was seen as the best way to do it. This was seen as the best way to kind of create a financial bond in your neighborhood. And people took pride. People took pride in owning these banks or being on the local bank boards. You can call it hokey or whatever, but people took pride in being a bank president, even if you were bank president of a town outside of Lincoln, Nebraska, with 500 people. You were the bank president. You were the guy that really understood the finances of that town. So from about 1945, what you think of as S&Ls are also interchangeably called thrifts, thrift institutions. Their assets go from $8.7 billion to $110.4 billion. Massive gain in wealth. Now, that's obviously the end of World War II. America's in sort of its golden age. Everyone is manufacturing. Everyone's got a job. Everyone can afford a house. You have the GIs coming back. You have the baby boom. Economic optimism plays a big effect in sort of the feedback loop. And the country's doing great. Everyone decides to go out, put their money in these institutions, and they get mortgages out of them. It's a very simple process, and there's not too much regulation going on at this point. There's sort of dabbles in deregulation. They're cutting agents here and there. They don't need as many regulators because the housing market's stable. Everything is stable. There's a great documentary, I've cited it before, called Money for Nothing. It's about the history of the Federal Reserve. It's more of a kind of a center-right Cato Institute take on the Federal Reserve, but it's very interesting. And there's this golden age is called by economists the Great Moderation. And it's this idea that Jim Grant talks about everything. If you could get everything just so, if you could get interest rates just so, if you could get the pricing markets just so, you could hit utopia. You could really understand how everything in the economy worked.
But it's not even like really understanding, but you can prevent crises.
Right. And you
like
can
people
achieve...
will still lose money, but it's sort of there will be no more bets that people didn't realize they were making.
Right. And you'll have sort of widespread prosperity. That was the idea as well. Everyone's going to have a home. Now, at this point, suburbs, as I think we talked about in our episode with Dark Enlightenment, at this point, suburbs are becoming a very, very large part of American society, mostly because of sort of like feral Negroes and a lot of the city areas, the Detroit riots, Watts riots in LA. A lot of the urban areas of America are imploding by the early 60s. Great for the housing market. Everyone is building out in the suburbs. Everyone's getting a mortgage. This is also part of like the Catholic blockbusting era that Michael Jones talks about. So all the white people building new homes outside the cities. And it's easy to get a mortgage. It's easy to go into these kind of communities, and sure enough, there'd be an S&L there. There'd be a thrift there. There'd be a credit union as well, and you could have pretty stable, pretty local financing for most of your basic services. Late 1960s, you start to see the cracks. You're not seeing cracks sort of in the fundamental housing system yet. You're seeing cracks in the general economy. So what happens in the late 60s? Well, we get really involved in Vietnam. And LBJ puts us on the Great Societies program. Spending gets out of control. War starts to get out of control. We're starting to ditch aspects of the reserve currency, or gold as a reserve currency for the dollar. And suddenly, interest rates fluctuate intensely. Now,
and inflation. That was
right. Inflation.
That was the big problem for banks, especially.
Well, I mean, it was interest rates that were particularly a big problem. Those are sort of the result of inflation because of the Fed, but these interest rates were particularly dangerous to S&Ls. Now, there's these very ridiculous technical terms that don't make too much sense called disintermediation or reintermediation. And disintermediation is basically just deposit withdrawal. That means people don't like what the interest rates are. They don't feel they're getting enough real value for their money that they're investing into these accounts, because they're seeing that the fact that a lot of these interest rates are capped. They're not able to gain any real wealth. Because in '66, Congress extended Regulation Q interest rate capping to these institutions. The idea at the time, when this was passed, or when this was passed for S&Ls, was that you were going to attract a lot of large-scale investors. You're going to get big capital influx. Didn't work at all. It had no effect. It had the very opposite effect. And you'll see that a couple times as we go deeper into this. You'll see that pretty much everything that they tried had the exact opposite effect, if you believe them at their word with what their intentions were. There's a good quote from Senator David Pryor of Arkansas. And he kind of lays out why S&Ls were starting to become a problem by the late 60s. Here's his quote. You got to remember that each community has a savings and loan. Some of 2, some of 4, and each of them has 7 or 8 board members. They own the Chevy dealership and the shoe store. And when we saw these people, we said, gosh, these are the people who are building the homes for people. These are the people who represent a dream that has worked in this country. They were also, of course, the very sort of people that politicians most want the support of. Now, as we get deeper into this problem and you see some of the issues of Regulation Q and as the and a lot of these bank board members and sort of lobbyists, early lobbyists from these S&L institutions start to flood Congress with requests and flood the presidents with requests, you kind of understand why they would respond. I think it's easy to look at the saving once you start getting into this, look at the savings and loan crisis and say, it was greedy people. It was Don Dixon, it was Charles Keating, it was Milken, it was all these fat cats that were real estate developers or junk bond salesmen. It was the Bush family embezzling money. Really, at the core of this, though, it's a revolution of the local bank board owner. The local bank board owner puts a huge amount of pressure on the elected officials to protect S&Ls because they were used to the golden era and they were used to the depression. They were used to this sort of stability. They saw it as stability for their neighborhoods, stability for the growth of their neighborhoods, especially areas that were kind of becoming mixed with suburbs. They were essential to growth.
This is the same political dynamic that ensures that your car dealerships are kept by hook or by crook in any Picayune town anywhere. If you look at what your car dealership is doing, they're doing a cook-off with the local police department. They're doing a fundraiser for the local fire department. They're employing the kids of your little city council members. They're the major employer. They're often like the biggest concentration of raw capital and inventory in that area. And whenever there's something like the Tesla situation, where somebody comes in and tries to cut them out and, for instance, deal directly with the manufacturer or cut them out of warranty sales, they're pretty ruthless in exploiting those political connections to make sure that they preserve their oligopoly.
And in very explicit ways. There are many laws, and I believe it may even be in states, not just counties or cities, that prevent non-dealership sold vehicles. And that obviously is
and not only that,
result of all
but
the lobbying they're doing.
There's a large number of laws that basically explicitly protect their franchises, so that it's extremely difficult to renegotiate franchise agreements. Some place like McDonald's, corporate has a very large amount of influence over kind of their internal pricing, how they're run, what stock they have to carry. For something like a car dealership, this is why certain brands of car dealership have a much better, worse reputation than others. Like Toyota, when they expanded into the U.S. In kind of mid 80s, they made a lot of sweetheart deals with the dealerships that they were trying to use to break into the U.S. market. That gave them a lot of freedom in how they operated. And so they kind of ended up not being able later to enforce kind of like a rebrand, which is one of the reasons why they had to launch Lexus under a different nameplate in the US.
Yeah, I mean, you get this idea now, especially because of the '08 crisis and especially because of the latter half and really the thick of the S&L crisis, when Keating and Dixon have their buddies on the bank board and their buddies in the Texas State Regulator's office, and they're hiring private auditors to clear their books. This is actually how Alan Greenspan gets part of his industry start, is cleaning the books for Keating. You get this impression that it's all these like really scheming Jews and rich wasps in $2,000 suits. They go to Washington and conspire to make your life miserable, conspire to steal from you, and so on. Well, it really, in a lot of ways, was, again, just local people trying to tell their congressman, if you want to win the House seat next year, you better find out a way for me to keep the S&L in the town center alive. Because right now, everyone's pulling their money out and they're going for money market funds. So by the late 60s, you've had kind of this weird stage in history where interest rates really went rising. This is sort of the great moderation I was talking about. Interest rates seem to be perfectly fine-tuned. From 1953 to 63, the interest rates on a 10-year T-bond, treasury bond, only went from 2.8% to 4%. So not even, a 50% increase in 10 years. Pretty solid. And keeping up with the rate of inflation, again, they thought they nailed it. They thought they'd really figured out the right balance to achieve, maximum out. From 65 or so from 63 to 82, so a 19-year difference, it goes up to 13.9%. So suddenly you're tripling. Actually more than tripling. 300% gain in interest rate values. It's insane. And this is just the beginning. That's sort of the beginning the real crisis starts. This is when, like 1970, 1971, money market fund becomes very popular. Now, money market fund is not capped by Regulation Q. This is another issue. In this grand scheme to control basically price market, the facts of pricing, certain things were left out. If you're going to have a sort of Soviet style economy where you have these giant Talmudic tomes of prices for everything everywhere, every transaction cost, every servicing cost, every product cost, you have to actually do that. You can't do it only for half of your financial system. So half of the housing market, basically half the financial system, has pricing caps, has interest rate caps. These new financial products, most people in Washington don't even know what they are. Don't even know what money market funds are. Most people, when they're first released, have no idea what they are. But they catch on very quickly because of Regulation Q, because interest rates start to rise very rapidly, and people are seeing that I'm not able to get a good return on my deposit. I need a real return for my money. So money market funds and other financial products at the time become very popular. This sort of disintermediation, this big capital outflow from savings and loans immediately causes problems. I mean, there's already at this point small failures, which is not, again, an aberration for American history, but signs of early cracks. That the reason some of these smaller banks are failing, and in some cases, banks in very wealthy suburbs where people or let's call them more sophisticated, they're much higher agency, they have more access to information, they're more likely to seek out this kind of information. They go with money market funds, pull their money to the local savings and loan bank. Bank collapses. No one really wants to deal with the hassle anymore. No one in the community feels like they need it. And maybe that community didn't need it anymore. Maybe it was a healthy growth, but other ones did. And the federal bank board spends time with FSLIC, sorting out the mess, merging the assets with other banks. And this costs money. This costs money to the taxpayers. They have to do investigations of fraud. Suddenly, there's millions of dollars adding up that need to be paid for just for this thing going under, even if everyone wanted it to go under. Again, poses another issue, and that even if there is healthy growth, a sort of healthy point where it doesn't really need this institution anymore, federal laws won't budge, and the structure won't budge, and you need to have people to oversee sort of the winding down of it. And the bureaucracy is massive at this point, and it's costing millions of dollars as things goes, even if everyone in the community was sort of willing to let it happen. There are still mortgages that need to be worked out. So I want to make a point about FSLIC. In 1960, and throughout most of the 60s, most S&Ls were actually not insured by FSLIC. They worked with their state bank boards, they worked with their state governments, they were state chartered. Because of this sort of old idea of American banking was still permissive. If you owned a bank in 1925, you maybe still owned a bank in 1960. And you were used to a structure that had very, very little to do, if you were a small town bank, with the federal government, if at all. Maybe you had no interaction. It's very possible. So only 20 to 30% of banks in the 60s are really interested in getting insured. But by the 90s, or I'm sorry, not the 90s, the 80s, 90-something percent, basically almost every S&L is insured by the federal government. Institutions that weren't insured were obviously not given perks, and they did not see the value in taking advantage of later regulation or dysregulation by not being a part of the federal system. So there are incentives to join this federal system and sort of ditch your state chartering if you could, because as we'll see with some of the regulation that, or deregulation that is regulation that's passed by Reagan, there are advantages. And this is sort of where the commercial real estate market comes into play. In 67, as the signs of failures are abound and money market funds are also being developed, state of Texas is the first big deregulator in this idea of S&Ls. So Texas tells its state chartered S&Ls, you can have up to 50% of your portfolio be property developments. Now in Texas, this is a very big deal. Undoubtedly, this was done by the Texas state government because, for those that don't know, Texas, even in the 60s, was sort of an underdeveloped state. It had a big economy, it had a lot of natural resources, had a lot of talent, had a lot of important institutions, but Austin was not very big. Dallas barely existed. Houston was not a big city. The cities were not very big. It was very much a small town state. Well, the story of Texas, of the crash in Texas in the 80s, sort of the end of 80s, finds its roots here. And what also finds its roots here, according to Professor Bill Black, and I ask you guys to look into him. He was a financial regulator and he was kind of at the front lines of the savings and loan crisis. He was the man who helped bring down Charles Keating. I think Keating tried to have him assassinated at one point. There's some weird incident where some guys, very 80s, some guys with handguns tried to lure Bill Black into the back of a white SUV and something or other, and he managed to get away. But Bill Black talks about how inside sort of the machine of deregulation in the Carter and Reagan administrations are tackling S&Ls because they're being told by constituents, I'm not voting for you unless you can do something about my S&L. They decide to model a lot of their ideas off of what Texas has been doing for 20 years. Now, they either didn't look at the underlying fundamentals, or they did and they didn't care, that Texas was already showing big signs of a property bubble. And coupled with the oil crash of the 80s, this is what destroyed the Texan economy for like a good decade. Just completely wiped out hundreds of billions of dollars in wealth in Texas. There used to be bumper stickers that Texans would have, please God, I promise to save if you just give me one more boom. Because people lived large. People made risky loans, they made risky investments. Oil money was everywhere. This is where that show Dallas comes from, kind of this boom period of Texas that everyone loved, and all these buildings were made, and Dallas, Fort Worth, and Houston are sort of constructed overnight. Large commercial real estate deals are done.
Great show, by the way. If anybody wants to see the growth of Texas, in particular in Dallas, just watch that show, and you'll literally see the sort of difference from then to today. And you can also watch the introductory sequences where they're showing all the buildings, and the buildings are like almost doubled by the end of the show in downtown Dallas.
Yeah. So it starts to get a little hazy here. In the 70s, again, you're just seeing sort of the growth of problems, right? You're not really seeing anything big. It's sort of boring.
Well, if we can go over the sort of fundamental issue here, to my understanding, what was happening was the banks are giving out loans. Let's say they were giving out a 10% a year interest rate, just as a simple number for a home mortgage, and then the government, the Federal Reserve, I should say, would change the interest rates such that they would have to pay effectively to attract savers more than they were getting from their loans, and so their costs would suddenly rise. So the cost being the amount they're paying the savers would maybe go to 12% a year. Now, this is probably a little bit too high, but effectively it would be higher. And so if you subtract out their actual operating costs, their effective cost of capital, let's say, is 12% now, and they're still locked into these 10% returns on their loan portfolio, and so effectively they're losing money. And so what I understand what happened was they were aggressively pushing relaxation in regulatory requirements for how much capital they had to have on hand and what types of investments they were able to make, so that they could effectively speculate with higher interest bearing portfolios like commercial real estate, so that they could finally reverse that negative ratio into a positive one. And they ended up making very, very bad investments in the process, and then making the problem even worse. But I'm just giving a very broad summary. But I think that's sort of the essential understanding of what was going on. And then they kept pyramiding up. They kept borrowing more. They kept pushing for more regulatory relaxation, and then they got deeper and deeper into debt, and it just took a couple decades, but eventually these things were really deep underwater.
They were already pretty deep underwater. By the mid 70s, actually not even the mid 70s, in 72, I think it was Senator Hunt, Congressman Hunt, the Hunt Commission basically determined what would end up happening about 15 years later, the totality of it. He looked at the situation and said, what we should probably do is realize these things are a product of depression, and they're a product of a very different kind of growth. He sort of modeled, and this is something that economists and people often don't do, he modeled the problems as being a problem of institutions existing outside of a time when they actually made sense, which is very difficult to say to people. If you go to your local savings and loan bank operator and you say, look, your bank just doesn't make sense in its current structure. It's not that you do anything bad, it's that the market fundamentals aren't there. What you do is just not really needed right now. It worked in big growth period, and it worked when we needed stability. Things have changed. We need to find a different path for these institutions. He recommended basically transforming the majority of them into savings institutions. Federal savings banks. Feds would have a very simple structure. They would just simply insure a mix of savings accounts. They could make commercial loans, these institutions, that they felt that whoever they were making the loan to met very incredibly stringent requirements, because Hunt sort of also foresaw the real estate boom as being a potential fallout, unregulated savings loans. And they could also get commercial paper. But Hunt, when ignored, no one really took him seriously because, again, time was pretty good. Interest rates were not growing that fast yet, and the market seemed to still make sense. You had small failures here and there, but the problems seemed isolated. When problems seem isolated and they seem like small hiccups, people are obviously less likely to solve them. That's sort of very basic behavioral economics. In 78, you have the financial institutions regulatory interest rate, which is kind of an overwhelming mouthful, but basically, it amongst many other sort of pork barrel items that go into this, and part of it is sort of a reach around tax reform. They allow S&Ls to put up to 5%. These are federally insured S&Ls. You start to see the perks of joining the federal system, and this was something that they really should never have done. This is a huge mistake because it centralized all this risk. But they start to tell S&Ls, well, you can put up to 5% of your assets pretty much anywhere. I mean, they try to structure it as, okay, you got to put it in construction or land development, but that means pretty much anything. That's very broad, it's very vague. And you start to see the real estate investors grinning because this is their moment. This is when they can really get a hold of an immense amount of untapped capital to finance their operations. A lot of people forget all the major villains of the S&L era, almost none of them were traditionally S&L bankers. None of them were small town guys. These were overwhelmingly bond salesmen, stock traders, political apparatchiks like the Bush kid or Neil Bush, and guys like Keating, Don Dixon, Charles Emery. These were all real estate guys.
Well, this is at the heart of the concept of disintermediation and what later became securitization in the 2008 financial crisis. I believe it's highly related. It's effectively taking these mortgage portfolios, bundling them, and then putting them off onto a distant trading floor or bond trading desk, whether it's in Wall Street or Santa Monica. I forget where Milken had his main operations, but I know he was Southern California.
In Santa Monica.
Yeah, so those effectively were being sold to large investors, typically pension funds or companies, or I don't know if mutual funds bought them. I think they were mainly stocks, but that's where they were sort of bundling things and making large amounts of money on their fees, because the larger the base amount, and if your fee stays the same, larger amount of money you're going to make. And so there was a large incentive for these guys to trade in this stuff. And I would assume that I don't know the details, but I would assume that these relaxations of the rules was allowing this to happen. And then that's how people like Milken got famous. And he was basically selling off these junk bonds, but of course he called them something euphemistic, I'm sure. But
high yield securities,
right?
You got to get that yield.
So you mentioned securitization. I was going to get to this at the end, but it's worth bringing up now. In the fallout of the famous loan crisis, Bush Senior, the smarter one. He, for those of you who probably weren't even alive, or I don't know, there probably have some youngsters listening to this show. There was once a warlord of America from the CIA known as Old Man George Bush, and he had this idea of creating and really extending the power of this body called the Resolution Trust Corporation. Now, the Resolution Trust Corporation was created in the fallout of Fizzling dying. Remember, half of the federal insurance for these institutions blew up. I mean, it was at the time, it was insane. It drove people nuts. You had death threats being issued. It was kind of like mass anarchy in a lot of small towns, in small town Florida, small town Pennsylvania. I mean, more than those places are already kind of like anarchy, especially Florida. It was nuts because you had people basically realizing they might not get any money, that they were fucked, that their deposits were fucked, and that some guy who they never met, because at this point, savings loan institutions didn't have to be owned by anyone who even county who lived in your state, took all the money out of the bank and left you with nothing. The Resolution Trust Corporation was created to resolve the problem slowly over time, and their big solution, the big idea that came out of the RTC, especially in the late 90s, was securitization of mortgages. And this instrument, in its more complex form, becomes a hot topic in the late 90s when you have Brooksley Born and others sort of trying to get a hold on these much even more advanced financial products based on what the RTC was doing, derivatives. You had the Gramm-Leach-Bliley Act, which allowed obviously the merger of commercials and saving institutions, but also completely deregulated in a lot of ways, created some, government bodies to oversee, but they had very little power, like the CFTC and other bodies over derivatives trading, over this complex financial product trading. This all literally comes out of the federal government. I mean, Milken and those guys came up with very rudimentary ideas for how to, but this was a product of the federal government to try and spin off these bad real estate products that they had. They had bad mortgages, people that should not have gotten a mortgage that were given one, so that Charles Keating could then dump the money into a real estate deal somewhere in Dallas and make a killing. That was the big play.
And let me just shill for the financial sector for a little bit. Like, none of this is kind of on face a terrible idea. Most of this ends up being things that you can justify through kind of very straightforward, kind of even assumption-free models of, for instance, we were talking about one of the big contributors to the collapse of the S&Ls was that they had this long-term versus short-term interest rate mismatch where their borrowing costs rose above their cash flows. And securitization essentially solves that. It lets you no longer be dependent on kind of your ongoing spot match between loans and deposits. Instead, like your ongoing loans, you securitize them, you sell them off. That's effectively your income. And essentially your bank is now operating as kind of a purchasing agent, like as a sales agent for loans that somebody else is taking the risk on. And if you're talking about like, some tiny branch or not even a branch, like a sole branch S&L outside of Omaha, their bets on long-term versus short-term interest rates are maybe not bets that they should be making.
Right.
So that can make total sense. You see this with tiny insurance companies too, where they don't do their own underwriting. Taking phone calls, they're doing servicing, they're doing evaluation of how risky people are, but the underlying pricing is somebody else's job. But I mean, the problem arises when you have kind of the combination of regulatory changes with this kind of mixed financial and political entrepreneurialism, where people realize there's a racket in here. There's a way that you can get a corner on some slice of the market, or some way that you can structure things where instead of the intended risk shifting, you've managed to just create a looting opportunity. You've managed to get some regulator to assume the risk for you, so you get all the profits and they end up having all the costs of failure. Or you end up packaging things and selling them to rubes and then skipping town.
Well, if I could counter shill, I guess that would be the term here, for this model of finance, I think securitization solves this, in quote, is good in theory and it's good in practice until it doesn't work. And I think the problem, at least in 2008, was that people were, as Hank points out, effectively, and I knew people who worked in this industry. I actually know several people who did this. They would get a job at a bank, and they would hustle people who walked in to get a loan, and then that loan would be put into the back office for some rubber stamping, and then they would be bundled up and sold off to some bank on Wall Street to then further sell it to some bank in Germany to be put into another financial institution in a pension fund somewhere in Stuttgart. And the whole thing of just this ridiculous supply chain of finance made no one accountable ultimately until the last person who was holding the bag had to pay.
They didn't have skin in the game.
Yeah, and they're disconnected from what's going on, and they have no idea how this stuff works. And so I think in the case of, there's two sides of a bank. There's the borrowing costs, and then there's the cash flows, as you said. And I think the problem of the S&L was that they didn't have much control over their cost of capital. That was effectively determined by the Fed. And so that was a sort of remote institution that they thought they could sort of balance out by having another remote institution sort of match up those spreads for them so that they were positive and they'd lock that in. That's the basis of sort of hedging and all that stuff. But the problem is you, small banker in Omaha, don't really have any control over what goes on at the Federal Reserve, and you don't have any control over what goes on in Wall Street. And if you're basically just flipping these things, the guys in Wall Street don't have any control over you. And so it's really a mess. And I think, my sort of recurring theme here is that if you can sort of concentrate things in a local area where you have both sides of the coin, you have a much better chance of accuracy and accountability. But that's just sort of my gut instinct on how this stuff should operate. But I like all the financial theory. I mean, believe me, it's very interesting stuff, and balancing the risks in using insurance models for trying to create investment portfolios by having non-correlated assets. It's all really neat stuff when you get into the math and stuff like that, and simulations and things like that. But then obviously it didn't work. And that's the sort of rub of all this stuff, and it's like, what are we really getting out of it? It's a huge casino, and it becomes this very
most of this stuff doesn't
thing.
require like crazy sophisticated financial modeling. It's just, what role are you actually going to play? Like who's like actually making the bet? Because in most of these things, there's kind of this like accretion of different levels of risks at different levels. Like, as soon as the bank has some sort of deposit insurance, like the feds are on the hook. So you've kind of capped your tail risk for certain events. As soon as you're selling stuff and taking a commission, that's a way of deferring risk. And, honestly, as like a buyer of financial products, there's no way in hell that a rational buyer of financial securities should want to be buying things from people that have no incentive to correctly estimate the risk. And it's sort of, it's like that scene in Goodfellas where like the restaurant owner gets in hock, and he realizes, okay, well, the only way to get out of hock is to squeeze this place for all it's worth. He basically burns not only his inventory, but he also burns his social capital that people trusted him. Because that's what the banking sector is ultimately about. Like, are you going to repay this debt? Like, are you going to get enough of a return on whatever you're using the money for that you can afford to pay me back? And he ultimately liquidates that, and his reputation is ruined and everything else. And that's what the banking sector seems to go through periodically as well. That you have this reputation for, forbearance, or for kind of low volatility returns, and they exploit that reputation every so often to do like a nice 40% cash grab.
Yeah. The RTC and a lot of the securitization, as Hank said, it made sense. It made sense at the time, but the reverse angle of this, I guess you could call it, the other half of the engine, is lowered lending standards. That's what really happened in 08. And you can go into all the legislation that caused that, but you boil it down, it was they were giving everyone a mortgage. I mean, they were giving guys a mortgage and a boat. Some guy that was making 50 grand a year in Florida was living in a $250,000 house. I mean, that became the larger issue. It wasn't these instruments themselves. I think when Elizabeth Warren and others go after these instruments, first of all, it's just fodder. But the incentives behind going after them are that, well, it's complex, I don't understand it, and it has to be bad. Not necessarily. And maybe they were wrong. Maybe Countrywide should not have given you that mortgage, by the way. Maybe that was part of the mistake, was thinking that, everyone in America can repay their home loan. That Angela Mozilla gave these wild speeches talking about his immigrant upbringing and how everyone should be owning a home in America to fight, I don't know, the old patriarchy or whatever. That became a larger part of the issue, and what became a larger part of the issue in S&L, and this is a good transition, is what really started to happen in the early 80s. And this is when the crisis really comes into full. So as probably very few will also know, there was this era in America called the Volcker era, where a literal giant, maybe not even from this planet, named Paul Volcker, took over the Federal Reserve. And,
was he like 6'9"? He is like a giant.
There's great press briefings where everyone is standing at a podium and Volcker is like standing behind all of them. I think his elbows are where the tops of their heads are, and he's just sort of leering down through those giant glasses at people. He looks like they're introducing some ambassador from an extraterrestrial species or something.
Like the big friendly giant.
Yeah, you guys should. I mean, Paul Volcker. If you want a good understanding of a cool cucumber, it's Paul Volcker. That's a guy that does not give a shit what you think. That will always know he's smarter than you, and he knows what he's doing more than you ever will. And that was his entire attitude at his time in the Fed. So he comes in, and he's what you'd call an inflation. He says, "Oh, American inflation is getting too high. I'm not going to allow that." And he starts raising interest rates.
We're done here.
We're done here.
We fucked around for long enough.
Yeah. So, he takes a big puff of his cigar. He tells the home builders, lobbyists to get fucked, and he raises interest rates by like 10%. And at one point in 1982, he actually had the prime rate hit 21%, 21.5, 22%, something like that. Somewhere between 21 and 22%. I mean, you're lucky to get 1% now. You really don't, but you're lucky if you get that.
Oh, prime Jesus rate. Christ. I was looking at this the other day, and I'm like, it's not even worth my time to transfer funds to the savings account because the pennies that I would get in return for my clicks is not worth it. I mean, it's so absurd today. I mean, basically the Fed is just flooding the financial sector with so much capital that they don't need to attract borrowers. And that's what the S&Ls were doing. They were sort of offering these outlandish rates, further increasing their cost of capital back in the, I guess, 70s and 80s. But, now that's no longer an issue. So
Volcker tells pretty much everyone to get fucked. And he just keeps doing it. This guy, just doesn't care. He keeps raising rates, and he keeps saying, "I'm going to fight inflation." And arguably, this is what killed Jimmy Carter's presidency, and it almost killed Reagan's reelection. Actually, Volcker's still alive by some miracle of nature. He's like Fidel Castro. He's probably going to live to outlive all of us.
Well, let's underline why he raised rates. It was inflation. I mean, it was a big,
inflation,
pernicious problem.
Yeah.
We can sort of say it was the oil crisis, but basically it was the government pumping money into the system that it didn't have. It was borrowing, and it was blowing money on Vietnam, and there was just a ton of price increases that were driving people crazy. And I forget what the nominal amount was. I think it probably was double digits, I believe. But Carter, Nixon, I guess Johnson had to deal with that. And it was the problem of the day. They had, I think Carter's problem was a quote unquote stagflation. Like the economy wasn't growing, but prices were going up. And so effectively you're losing your spending power at that point.
And Jimmy Carter, I mean, Trump has talked about this. If you're going to be president, America's the brand, okay? And you're the chief promoter of the brand. And that's how you can get your way out of crisis sometimes, promoting the brand. Jimmy Carter is just so ineffective. You basically tell people that tough, like we have inflation.
Things
tough.
are going to suck for a while, guys.
Well, he was famous for telling people to wear a sweater during the energy crisis. And Reagan just walloped him. He comes in and he's like, "Hey, don't you want America to be great? It's very Trumpian. No, it's Soviets' fault. We're gonna build our military. It's very simplistic stuff, but it appeals to people because they externalize the problems.
So this guy, he basically killed Volcker kills Carter's presidency, and I was saying he almost killed Reagan's reelection. And Volcker was talking about this recently.
Well, there was a pretty bad recession. I mean, let's just articulate exactly what happened. So the interest rates go up. I forget exactly how much he raises them, but it was a lot. And the borrowing costs of your farmer, your factory, your small business owner go up to the point if they have thin margins, they have a real hard time making payroll, and so spending gets cut. Which is a knock-on effect to the economy, which causes further spending cuts in other sectors, which creates a recession. And so that was, it causes unemployment. So that basically causes people to be very unhappy. And so Carter's appointment of Volcker, as you say, probably cost him a big part of the presidency. And it also put Reagan's presidency in peril too, because this policy was still in effect and the recession was dragging on and on. And it wasn't, I think, until about 82 or 3 when the economy started picking up again, and then Reagan won re-election. But it was very questionable for a while there.
Yeah, you see all sorts of weird stuff once interest rates hit like 20% a year. I mean, that's like 1.5% a month. And I mean, you saw like consumer companies effectively trying to borrow from their consumers. So there were a lot of airlines at the time. There's still a few of these legacy ticket holders out there, but essentially for some amount of money, you could just buy unlimited plane tickets, like for life, for you and the companion. So, I mean, people, it's like, fuck it. I've got, money from whatever. Like, I like flying. So here's, 20 grand or something ridiculous in $1982. They've been flying nonstop ever since. And
the boomers have been going to Boca Raton ever since.
Yeah, a lot of these companies, like, they weren't the only ones. Like, there were a lot of these kind of bizarre subscription kind of quasi loan companies. There, you saw like barter shops pop up, like where just complete pre-monetization. Like, I'm gonna bring in my old Stones records or whatever and like try to get eggs for them. But it's extremely distortionary. Like, if you can get inflation under control, then at least you don't have the problem of like money no longer becomes worth anything. So, you're forced to demonetize. But with interest rates edging up that high, like your sort of time preference and just like the role of time, the economy, it starts to be able to kind of see the curvature of the earth, implying
there is one. I'm talking about, dude.
Wouldn't that be cool if you could see one of those?
So in 1980, the Federal Home Loan Bank Board basically knows the jig is up. More or less, the analysts inside of the bank board know. Half of them are friends of people like Keating, who are about willing to do anything and don't really try very hard jobs. And Reagan is coming in, and there's sort of this new idea of American capitalism taking over, so they're sort of stepping back. But they know that the problems are unsolvable at this point, this industry. So they do what they think they can to resuscitate it. They basically say, you only need 3% in reserve requirements, which is a recipe for disaster.
This is nothing.
Yeah.
Like that is nothing.
Yeah.
Like when you're talking about 3% reserves, so it's like, okay, so okay, if you look at any like banking 101 like economics textbook, they have this idea that they put forward that's complete falsehood, that, well, you know, I have $1 because I got paid from the government or something. So I walk over to the bank and I put in my $1. And then the bank says, oh, I have $1, so I can do whatever the inverse is of my reserve ratio of loans. And so they make a 3%, like they loan out $33. That's not what happens. What actually happens is the bank has people whose job it is to write loans. And they also have people whose job it is to collect deposits. And they don't it's not like there's like a big box of money that like goes through and like hits like the magic money multiplying machine and then turns into loans. No, they just like write loans.
Right.
Like they just, the money is literally invented out of nothing.
This is the Bill Ackerman videos.
There to like keep some brakes on the train.
Yeah. This is like those Bill Ackerman videos where he's trying to explain the economy through a lemonade stand. Like, you asshole.
It's like, Jesus Christ.
Well, if I could give a
fucking crocodile hedge fund manager talking about the lemonade stand. It's
yeah, no. Well, the funny thing is, hedge fund managers probably don't know how to do anything in the real world other than probably operate a lemon stand. I mean, they sit at a desk and a computer screen in front of them. What the hell do they know? But no, if I can make sort of a somewhat, hopefully more helpful real world example about why keeping a small reserve ratio in your bank is a bad idea. It's kind of like assuming that, let's say you're taking a really long road trip and you have 3% of your fuel tank that's full. But you know, because you looked at the map, that the gas stations are spaced such that you only need 3% of your total fuel tank's capacity to get to the next station every time. Well, let's say one of those stations burns down in a horrible fire. Or let's say you take a wrong turn and you go off to a different place and your map no longer is valid. Well, suddenly you run out of gas. That's effectively what happened to a lot of these banks, is that, like, look, they didn't match up their sort of forecast correctly, and suddenly their reserves which is basically like their cash, their 3% of their assets or liabilities or whatever the requirement is, it runs out. So they ran out of gas. And if you had a little bit more in the tank, you'd have less of a chance of that happening. It's just, to me, it's as kind of simple as that.
All right. So I'm going to say some more stuff that's going to trigger the both. Just let me get through it, and then we can be mad about how much they fucked up. Okay. So Bank Board also starts changing accounting requirements. I can feel Hank's anger rising right now.
It sounds intriguing.
They basically stopped fully using GAAP. For those who don't know, if you haven't been in business school or you just don't deal with this stuff regularly, GAAP is generally accepted accounting principle.
It means how you fucking do it.
Right. Now, GAAP is maintained by a lot of very, very smart people across America. Most of them are private individuals who do this sort of out of passion, honestly. So you think of it as a big open source project for accounting. This is how accounting has sort of slowly evolved into, in the United States, kind of a good system. But the bank board tells S&Ls, you don't have to do that anymore. Don't worry. You can change the accounting requirements for what you need to report and how you report it. So suddenly S&Ls that were showing minor improfitability start showing 10% profitability overnight, just by changing the accounting standards. This is actually part of what Bill Black had been finding. And I want to stress too that CPAs and auditors, private auditors, were blamed. Large small firms were blamed for this crisis. They were blamed for not catching it. They were the ones reporting it. There were an insane amount of reports, especially in California. The California S&L market was immense and very complex, and the California state regulators just totally dropped them. And there were a number of private accountants, including ones associated with Keating, who were telling the state regulators, the state bank board regulators, look, there's this huge problem here. They are not reporting revenue properly, they're not reporting assets properly, and any honest accounting of the assets they have on their books shows this to be an intractable situation. Then the bank board decides, this is all part, by the way, this is all various regulations that they're starting to issue, the bank board. It also kind of blends in with something called the Depository Institutions Deregulation and Monetary Control Act. And you also have the bank board and this act both saying the same thing, that anyone can own an S&L anywhere in the country. You can live in California and you can own a Nebraska chartered S&L. So you can kind of figure out why that might be a problem. But if you don't necessarily live somewhere and you don't maintain those close, low-scale banking relations that Hank was talking about at a very, very micro scale, sort of in the town, you have no idea what you're doing. And
it's more likely to be the opposite. It's more likely that you know exactly what you're doing, and
you're trying to
realize that I no longer am subject to the same banking regulations as I would be if I actually, because you can personally own a bank. Like, you can do it. It's difficult, and they're usually structured as corporations. But I mean, in principle, there's nothing really legally preventing you from starting a bank. You just have to go through all the hoops. But if you don't have to go through all the hoops, then that's when you start hiring your buddies, and you have very lax accounting, and money just sort of starts disappearing. You start making loans to your friends. Those loans never get paid back. You get a kickback.
One of the last things they did was basically determine that you could use tangible assets, such as land and property, developed property, to finance and basically barter for a controlling interest in a thrift. So if you are a real estate developer, you can use all that real estate you might have, or all that commercial property you have, to get a savings and loan, use it to finance more real estate. You kind of start to see how much of a problem this is. But it gets worse. Theme of the show, it gets worse. It's actually much worse than that. Well, it's about to get much worse. So Ronnie Reagan is in the White House at this point in 1982. And Ronald Reagan realizes, holy shit, I just inherited a huge problem, and the last guy had no idea what he was doing. So I'm going to basically let this industry run wild and see if it fixes itself. Now, by 1981, pretty much because of these incredibly high interest rates, we're dealing with interest rates well above 15% in 1981. Pretty much every S&L is reporting a loss. It's a bad year, very bad year. Some of them are pretty much insolvent. About 10% are considered just totally insolvent. Not worth saving, but they're kind of kept alive. So by 1982, you had obviously getting to the prime rate, 21%, then it started to descend very rapidly. But in December of 1982, you have the Garn St. Germain Depository Institutions Act. This is when you start to finally understand why allowing every single S&L in the country to join FISLIC was an incredibly bad idea. They basically tell every S&L associated with FISLIC, which is at about 90 and about to go to about 100 after this, 90%. You can diversify your activity. As soon as you hear the word diversify your portfolio, diversify your activity, that's when you know that you're being huckstered. They tell S&Ls to make, or they basically don't tell them. They're kind of telling them, but they're allowing them to make up to 70% of their portfolios just real estate and consumer loans. So you have an industry still staffed and owned mostly by people who have mostly no idea what they're doing with the real estate loans, real estate deals, commercial real estate deals, or personal loans, just any kind of small commercial loan. No clue. They become full service banks. But they're completely insured by the federal government. They have state and federal protection, most of them. They have every kind of perk imaginable, no accountability, and anyone can start one up and own one from anywhere in the United States. So here's a quote from a very long article on the subject that kind of breaks down what's going on. State regulators were forced to follow suit as state-chartered S&Ls pushed to join the federal system with its new freedoms. If they hadn't, they soon would have found themselves with nothing left to regulate, and state politicians would have found themselves without the campaign contributions of the Chevy dealers and the shoe store owners. California, which had the largest state S&L system by far, promptly upped the ante and allowed state-chartered thrifts to invest in whatever they pleased, from junk bonds to alternative energy schemes. California thrifts, in other words, became far more than full-service banks. They became venture capitalists. The only difference is that any losses were guaranteed by the government. So this is sort of the result of Larry, the local thrift owner, throwing revolt in the 70s and basically telling congressmen, you got to get this done. You got to help me out. Things are not good here. Well, they go to Reagan, and by the way, this is a Democrat Congress. In a slightly, but almost, I think it was like 52 Republican senators to 48 Democrat senators. Democrats have a huge amount of control in Washington at this point. So they're just as much culpable, and they go along with this, and they get along perfectly with Reagan on getting this done. Well, things start to really, really get bad. Reagan has a nice little soiree with S&L owners, S&L lobbyists and operators, and says, I think we nailed it. That's a direct quote. I think we nailed it after they passed this legislation. And he called it the Emancipation Proclamation of the American banking sector. The result was that you had about 100% financing by these S&Ls and by virtue of the federal government of about anything, and no down payment. Down payments are effectively done away with in most cases for a lot of being approved. You could just create an S&L or buy one and loan yourself money, and no one would stop you. That was actually became a common game. It was mostly the fraud being committed was not these complex real estate deals. It was literally just, I want $1 million, and I'm going to take $1 million after I buy this S&L.
And this is possible because of this money creation trick.
Yeah.
That like you loan out of nothing, and theoretically those loans are backed by whatever assets you have in reserve. Only if you're not following GAAP and you're able to invest in assets that are very difficult to correctly value, even under optimistic assumptions, you can be like, oh, well, I invested in a gold mine and there's no gold that we found yet, but we're pretty sure there's a lot of gold in the ground. And so we're going to say this is, $1 million gold mine that I just bought. And so, 3% reserve ratio, I can loan up to $30 million to myself and my cronies out of the sort of paper value of those assets. And this, this is why, like, your banking sector. I mean, people again, like, they have this idea that the banking sector is somehow kind of. I don't think that people have a good understanding of why it's so possible for your banking sector to really screw up your economy. And I don't think that it really mechanically has anything to do with, oh my God, like, we won't be able to get loans. It's much more the opposite, that if you have a banking sector that's completely out of control like that, then they end up with just vast amounts of fraud. And when you try to shut it down, it's very disruptive to whatever legitimate depositors you have.
Mm-hmm.
But I mean, I think it's really the ability to abuse this extraordinary privilege of money creation that ends up being at the root of most modern banking system failures. Like, not necessarily the historic ones going back to, Great Depression and before, but I think a lot of the modern ones, they all seem to have very large kind of accounting abuse components.
Yeah. Between 82 and 85, industry assets increased by 56%. There's S&Ls basically tripling in size. Some of them are even growing by 100% in the bigger states: Florida, Pennsylvania, California, Texas. By 1980, so from 1980 to 1982, just so you guys have a clear picture of what's really going on here. In 1980, American S&Ls had a collective worth of about $32.2 billion, which is a big come down from where they used to be. By 1982, they were at about $3.7 billion. So they're owning incredible amounts of assets, and they're worth nothing. They're worth nothing. They have no real worth under GAAP. But under these other accounting standards that are, they have incredible value. These institutions are sound. There's only a few ones that are failing, and they're isolated cases, instead of this being a widespread problem. So by 83, it's really kind of already over. The California government passes a piece of state legislation that basically says that anyone can charter an S&L bank, and then within a year the home board or the home bank board passes similar or makes similar rulings. Anyone can own one. Anyone can create one. Getting a state charter, especially in California, no problem. Just got to appeal to the state board and you're fine. Pretty much no one was ever denied. In fact, there are almost no cases of someone being denied a charter for a savings and loan bank at this point. By 85, it's over for FSLIC, and then in early 1986, FSLIC is basically dead. It's declared completely insolvent, and it's insuring 98% of all assets owned by savings and loan institutions. This is commercial real estate. This is undeveloped land. This is commercial loans. This is personal loans. This is fraudulent activity. This is a big batch of everything that happens to be insured by the feds. So the feds realize, this is over. They immediately start trying to ram through a lot of extra tax cuts, some of which get passed, some of which don't, because Reagan and the administration know that if they don't do something, the American economy could crash. The entire economy could crash. They get 1986 Tax Act through, and It gets taxes from 50% down to 30% for the marginal tax rate, and that kind of staves off a lot of these issues. Had they not done that, I think you very well could have seen a multi-state collapse. Maybe not just Texas. You could have seen California. You could have seen parts of Florida. You could have seen definitely parts of the Midwest completely implode, especially at the housing market level. In the late 80s, after the oil crash, you had a real estate bubble crash. Now, a lot of these S&Ls owned real estate. All these S&L bank operators decided to put all their money, because the feds allowed them to and kind of encouraged them to, put money into commercial real estate to create another boom. Reagan needed a boom. He needed tax cuts, and he needed an economic boom. He needed new building. He needed economic stimulation. He needed capital investment. This is how he was doing. And it crashed. When the prices crashed for real estate, that was it. 87. There was almost no S&L in the entire country. We're talking thousands. There's almost no S&L that is solvent. I'm not saying reporting losses. I'm saying solvent. They are almost all completely underwater and have no ability to get out. These are, at this point, these are institutions that are doing actually very little servicing of mortgages anymore. They are basically collection bins for all kinds of different commercial loans, property loans, real estate deals. Very bizarre sort of transformation of institutions. It's weird to see financial institutions sort of shift like that and become something that they were very much not intended to be. But I think that by the late 80s as well, you have people like Charles Keating start to feel the heat. There is, of course, in the late 80s and early 90s, you have a Keating 5 scandal. This is sort of one of the few pieces of history I think everyone probably get in your history books. Charles Keating, again, real estate developer, bought up S&Ls and used them to kind of fund more real estate activities. He was fried. You knew he was going to go to jail. But he had several senators that he worked with. De Concini, John McCain, Alan Cranston, John Glenn, and Donald Reigel. They are known as the Keating Five. Now, everyone knows who John McCain is. It's very hard not to know who John McCain is. The other four are sort of unknown, I think, to most people because their political careers were destroyed. This scandal ended those four men's senatorial careers permanently. I mean, they never recovered. The political fallout as things started to unfold was huge. What's never really talked about very often is how much fallout there was at the local level, mayoral races, state house races, local district races for state assemblies, state legislatures. Lots of losses. If you were on the wrong side of this crisis, if you happen to be involved with an S&L, you happen to be involved with someone who was involved with an S&L, or you didn't do enough, or just were already unpopular and this crisis hit in the wrong neighborhood, you were done. Your political career was over. The House was Democrat majority, thoroughly Democrat majority. And the Speaker of the House lost his speakership, and the House Majority Whip as well, who were both Democrats, lost their political careers because they had taken lobbyist funds from S&L operators. The people who were most pointing to point this out often were obviously Reagan, but Bush Sr. Took a hard line, ironically, on S&Ls, given his son's strange activities with them. Between Reagan and especially Bush Sr., 1,100 people went to jail or were at least prosecuted and spent time in jail or paid fines.
That's not unusual for a guy like that. If we can talk about the involvement of the Bush family with the S&Ls and more broadly speaking, the CIA's usage of them as institutions to put funds through for their various operations. Effectively, the CIA, and remember, George Bush Sr. was head of that and still heavily involved during the Reagan administrations and during his own presidency in the operation of the CIA and various operations in Central America, especially, and also around the world. That organization typically operates with a large number of agents and assets that are actually not officially part of the CIA, and these people are extremely disposable. And so when there is a scandal or something that doesn't get covered up properly, the basic strategy is to eliminate any risks of further leaks, and typically these people are rounded up and they're put into jail, and that's given as sort of a evidence to the public that this is being taken care of, and that the people at the top, of course, are unaware of these operations and the details. They're just trying to represent the public at this point. But there's been a lot of cases, Iran-Contra. There's been the drug running scandals where a lot of these people get rolled up after they've been used and paid by the system. But in order to cover it up and to eliminate and to threaten people from not revealing higher level involvement, these cleanup operations are very common. So it doesn't surprise me that a lot of these people would go to jail, but Bush would try to stay above the fray.
Yeah, in 1990, the House Permanent Select Committee on Intelligence was receiving a lot of tips and seeing some reports, especially in like the Dallas Chronicle by local reporters, that there were seemed to be very clear connections between CIA activity and certain accounts at certain savings loan institutions.
Yeah, there were a couple, Silverado savings loan, and I believe it was. Go ahead.
They were arguably with between 18 to 22, and they caused the failures of about 14 of them, allegedly, just through fraudulent activity and obviously just bad disintermediation. That was the point. But Frank Annunzio, who was a Democrat from Illinois, he was the chairman of the banking committee, and actually he was chairman of the banking committee subcommittee on financial institution supervision, regulation, and insurance. He sent a letter basically to the CIA, directly to the CIA director, William Webster, and asked him to come testify and try to understand why it was that CIA money was being reported as being involved in failed S&L institutions. Remember, this is after Iran-Contra. I mean, Iran-Contra is fresh in everyone's mind. And there's still a lot of unanswered questions. And there's still unanswered questions about where CIA funding came from for all the black ops involved in Afghanistan and Pakistan. Where exactly was CIA getting money to, buy Israeli weapons or buy weapons from Egypt to get into Pakistan? It's never really been revealed what exactly was used to finance a lot of these arms transfers. The assumption that's often made that sort of corresponds with the timing of these bank failures and the activity is that the CIA was involved with these institutions because, again, they needed money. And fraud was pretty much, the auditors felt that fraud was the chief reason why these particular 22 institutions fell. Well, the CIA cited national security concerns, and they told federal regulators to get fucked, and that they were not allowed to pursue funds related to some of these insolvent thrifts, and that was basically admitting that these accounts tie back to.
There was a long series. I believe it started at the IRS, and then that they went to the Justice Department, who then went to the FBI. Then the FBI finally went to the CIA, and the CIA told the FBI not to investigate this Iranian guy named I believe his name was Azima, and I think the quote was, "This man is off limits." And at that point, the FBI stopped investigating. Sort of interesting how the CIA gets to decide who is
Yeah.
allowed to be investigated in this country.
Well, as Zima was involved in trusts, or I'm not, or yeah, basically thrift banks and trust banks in Oklahoma, in
Kansas City, I think.
Kansas City, which is a long history of glow in the dark and mob activity. We've talked about that on our episodes in the American Syndicate, but basically, this guy, amongst a lot of other characters, including members of well-known Italian organized crime, have been involved with savings and loans institutions prior to this mess. They were involved in some in Broward County, Florida. They were involved in these ones in Kansas City. They were involved in a lot of them in Texas, and some of the ones in upstate New York. But anyways, the Frank Annunzio gets from William Webster, who also declines to show up and testify. And Annunzio writes a letter to the committee, the Intelligence Committee, different committee, and he says, the refusal of the agency to respond to the subcommittee's request and the initial investigative work done by the subcommittee staff have led me to believe that at least some of the Houston Post's allegations have validity. No agency is above the law. The CIA, in turn, called the reports scurrilous and unsubstantiated, and then said they wouldn't cooperate with any investigation. So, if you get really into the details, Silverado shows up, and it's this thrift that had connections to a member of the Louisiana Mafia named Carlos Marcello. And the developers who were involved with this institution, or an institution that was related to Silverado, were personal friends and business partners of Neil Bush on other projects. It kind of falls apart from there, but generally the idea you can get from this was probably related to Contra and more related to activities in the Middle East and Latin America. I guess we can kind of start to wrap up here. The savings and loan crisis becomes a hot potato. It becomes very, very, very important in the re-election, or the attempted re-election of Bush. And there's this very kind of common political refrain: who is the S&L president? Is it you, President Bush? Are you the S&L president? And it's just sort of, it's stupid. And there was a big political fight back and forth about who really caused the S&L. And Bush was enticed to ramp up going after people and ramp up bailing out a lot of accounts, bailing out a lot of deposits, bailing out a lot of small town S&Ls. You can call it cynical. He's trying to get their votes, but he felt the pressure. And a guy like Bush Sr., when he feels the pressure, he acts. And he acted. He threw these guys in jail. He made sure Keating was put away for several years. He pretty much destroyed Michael Milken's life, or had Michael Milken's life destroyed, I should say.
Well, for a while, Milken's always.
I think he was in the news again recently.
No, he's
God,
fine
now.
So
he's
much positive press now. It's unbelievable. he has these conferences at the Milken Institute. It's sort of like I don't know, the Hoover Institute for Southern California. The Milken Institute. They have these big conferences.
Oh, God.
And it's this big smiling, bald, weird face, and he's got all this money going to cancer research, but you never read a bad article about the guy. I mean, it's Forbes magazine loves him. I mean, it's crazy.
So, as this thing starts to implode, they find there's about $1 trillion worth of assets they got to work. That's when the RTC gets set up. Congress sets that up, but Bush is the one really kind of running it. That's the sort of inside baseball, is that the president and his guys were overseeing and the thing worked and were making sure that certain people got their full money back and that certain people were highly punished for what happened. One of the weird things that happened was that they immediately threw in sort of a regulation act, and it was called Financial Institutions Reform, Recovery, and Enforcement Act. And it was this idea: we got to re-regulate. And it produced the 1990 recession. It helped produce it. Basically, banks and the remaining S&Ls that weren't too bad, they reduced loans by about 8 times the amount of declining. So the economy halted. If you can't get credit, if you can't get a loan to make something new, invest, stock your shelves, get inventory, you're going to have a recession. There's no growth. It didn't really evolve much from there. At that point, big cost to the government, several $100 billion. They had to resolve and found various ways to sort of spin it off. Within a few years, sort of the tech bubble took hold and the collapse of the Soviet Union was complete. And America was finding itself sort of head of the global economy. There's a lot of optimism in the economy. People are investing again. America's making all these trade deals. America is finding various ways. I think really Clinton is finding various ways to enrich people using whatever he can. There's a lot of deregulation of certain financial instruments, as we talked about earlier. There's a lot of deregulation of the tech sector, and things start to improve very quickly. And the S&L crisis becomes very forgotten very quickly. A lot of people never really recovered. Texas took a very long time to recover. There were communities that were devastated permanently as a result of it. But generally, because of everything else going on with the country, particularly victory in the Cold War, it was very, very quickly forgotten. I think that if America had maybe won a war against, had successfully won, whatever that means, in Iraq and Afghanistan around the time of the 2008 crisis, people might have been slightly less pissed off. And that is in my theory, part of the reason why this is so quickly forgotten. There was this very dark period that people had to deal with, but then there was this light at the end of the tunnel. We're the masters of the universe now. We had to go through some dark times, and we had to do some tough things with Ronnie, but we got it done.